Hello and welcome to the fiscal year 2018 inSight Budget Module Training for Facility Services. We're going to review budgeting basic concepts and go through a demonstration of the inSight Budget Module for fiscal year 2018. So when it comes to budgeting, the very first thing you need to know is your contract. How your contract type, whether it's a profit and loss contract, a cost plus contract, or a limited profit and loss contract. You need to know how those contract types affect how you make your revenue and your profit, and how those calculations are affected within inSight. It's also important to know the specifics of your contract terms in regards to billable and non-billable costs and any allowable annual billing changes. We're going to want to budget based on trends, and when we base on trends, it's important to know whether your revenue or expense line items are monthly fixed amounts, weekly amounts that are affected by your 5-week fiscal periods, whether there's any seasonal fluctuations or significant one-time expense or revenue events. It's helpful to use the results of your previous year's performance, the current fiscal year projection, to predict future performance. When it comes to budgeting based on one-time events, it's important to be aware and know whether those one-time events have already occurred in the current fiscal year and reflected in the current fiscal year to date values, or if those one-time events are yet to occur and not yet reflected, so that you can account for those when you're building your budget. Some examples of one-time events are scheduled events or special events, incentives, capital purchases that take place mid-year, contractual annual fee increases, and scope of service changes. So in regards to the inSight Budget module, before we get into the actual module, there's a few things I want to review. First of all, there is documentation available within the module where you'll be able to pull up the fiscal year 2018 calendar, and there's also a detailed screen-by-screen questionnaire guide on how to use the budget module. When it comes to maneuvering and the reporting features of the inSight budgeting module, it's just the same as the projection module that most of you are already familiar with from the current fiscal year. I also want to recommend and remind you of the feature of using the center comments for documenting any budgeting notes of any things that you budget, any backup documentation or reason or explanation of how you came to some of your budget values for possible review with your district manager or regional finance director as you go through the budgeting process. It's also important to review the results as you're building your budget as you go through each questionnaire to ensure that the revenue and profit are behaving as expected based on your contract type. And also it's helpful to compare to your current fiscal year 2017 projected performance to ensure that your budget you're building is in alignment with your current trends. So the next thing we're going to do is go into the actual budget module and do a hands-on demonstration of all the questionnaires. When you first log into the budget module, just as you do with the projection module, the first thing you're going to have to do is to log in with your login credentials. You're going to have to complete a communication session, and you need to check out your profit center numbers so that you can make edit changes. If you properly check out your location, as you move through the questionnaire, you will see that there are sections that are grayed out, which you cannot make any changes to, and there will be sections that are white where you can make editing changes. The very first screen that opens up is the Profit Center General Setup screen. You just want to review this screen to ensure all data here is accurate based on your contract. If you come across anything on this screen that you feel that is in error, you will need to submit a request to our corporate market analyst, Danielle Anzalone, to make any requested changes. As I mentioned on the PowerPoint, there's documentation in here. You can pull up your accounting calendar for the fiscal year 2018 budget year. May be helpful to reference while you are building your budget. And within documentation, you will also see the user manual for facility services that's available within the system. It's a 32-page document that has all the detail of every one of the questionnaires that you're going to be visiting throughout the budgeting process, which we will be going through right now. As I mentioned, this is going to function very similar to the projection module. On the bottom right of the screen, you'll see the next button, which will advance you through each of the questionnaires. The first time you go through the budget, I recommend you go through each questionnaire one at a time. When you revisit the budget, if you need to focus on any specific questionnaire, you can skip straight to that questionnaire by using the menu selections and skipping right to whatever questionnaire you need to edit. There's also the comment button on the bottom of the left of the screen here. This is your center comments where you can, it's an open text box where you can type in any comments of anything you want that might help you with your conversations with your regional finance director or district manager to explain and justify how you came to certain values on each of your questionnaires. With some of the other screens, you will not find that comments box. You can always get back to that comment box from any questionnaire by clicking on the results first, and then within the results screen, clicking on View Center Comments. And that View Center Comments will bring up the same comments box where you can continue to add on to your comments. So now we're going to go ahead and advance through each screen and visit some of the key concepts on each of these screens as we go through the budget process. So on the bottom of the screen, you can see that it has the fiscal year 2017 actual projection total profit of $45,000 for this example. And currently for the fiscal year 2018 budget, it has a total frontline contribution or profit of $0. As you complete each screen and click on the calculate button, it will update your profit so you can make sure you're within alignment with your previous year's budgeted profit as expected. And again, to see the revenue or any other detailed line item result comparison, you can click on the results button and you'll see the fiscal year 2017 full year actual projection based on your current projection values through the remainder of the current fiscal year, and compare it to your 2018 plan for the full year as you progress through the budgeting process. On this first screen, the contract revenue screen, this first line, this is where you enter in the contractual billable amount, whether it's referred to as your management fee or your general administrative fee or just contractual fee. You would plug in that amount here. And then you need to determine, based on your contract, whether this fee is based on a bi-weekly rate, a 4-week rate, a monthly rate, a semi-monthly rate, or a weekly rate. For the sake of this example, we're going to go with a weekly rate. Over to the right, this revenue amendment, again, is based on the contract of when you're contractually allowed to increase that fee. Generally, it's on the anniversary date of your contract start date. And you would select the month of whenever that anniversary date is and the percent change you're anticipating that increase to be. You will receive from your regional finance director or district manager guidelines on what percentage to budget for. For this example, we'll just budget an estimated 2.5% increase. As you build these in, you'll see that it'll automatically populate each month based on the spread type that we selected. And as we click calculate, it'll start to build our profit. At this point, for this P&L type, this profit is reflecting 100% of our fee for the full year. As we continue through the questionnaires and start building in all of our expenses, those expenses will start reducing this profit amount until we end the budget and get close to our budgeted or our previous fiscal year's profit amount. When we're done with this screen, we can click on Next to continue to the next questionnaire. Now this screen is a very important screen that I've noticed in the previous fiscal years that many managers have failed to understand completely or have used incorrectly. This screen is specific to cost plus accounts and limited P&Ls, where we have a combination of a P&L contract and a pass-through of certain items. It's very important that you understand the use of this screen because it will accurately build your revenue and profit throughout the budget process. Again, you need to refer to your contract to determine what is billable and what is not billable based on your contract terms and what that default markup percentage should be. In general, it's going to be 100%. That we're just passing through our costs at 100% cost to our client. Or if you have a contract that actually calls for a flat fee amount to bill in addition to your pass-through costs, then you would type in that flat fee amount in this box. So with this example, we're going with the example of a markup of 100%, which means we're just passing through certain costs to the client at our cost. The screen over here on the right lists all of the available expense line items. By default, they're all included in your reimbursable billable expenses. If you have a line item per your contract terms that you cannot bill the client, then you need to check the box that says exclude. For example, by default, you see right now relocation expense, charitable contributions, and risk insurance are checked off as excluded. So if you incur or budget for expenses in these categories, they will not increase the revenue on a cost plus or a limited P&L, but will come directly out of your profit. For any line item where you do not check the box as excluded, then it's telling the system that these are reimbursable costs that will be added to your revenue, billable to the client as you build those budget amounts. In a straight P&L account, this screen has no effect. You can leave the default markup at 0 and just ignore the screen and proceed. But for a cost plus or a limited P&L, again, it's very important that you properly use this screen's functionality to designate what is or is not billable to the client. The revenue other screen. This screen is used for other revenue not already accounted for in the contract billing rate that we entered on the previous screen. Some examples could be project worked or agency labor. Excuse me, not agency labor. Agency labor will be reflected on one of the expense screens later on. Other examples of other revenue could be one-time events or incentives. So for this example, we'll go ahead and use a couple different features. First of all, I want to draw your attention to the use of the worksheet and the spread type. The worksheet can be used to detail in various items in one account item for your benefit of detailing how you built that budget line item. So for example, under project work, we could have project work of $20,000 that we plan to budget for the full year. That project work could be spread as revenue based on a 4 or 5 week period, or it can be an even spread for the whole year, or it could be a one-time project that maybe you're planning in the summer. Let's use grounds as an example. That maybe there's just a $2,000 in revenue for the months of June, July, and August, and that will then default to a spread type of none since we're budgeting based on specific months. But if this $20,000 project work is built of various events and you want to have a little more detail for you to better manage when you come to your actual operating budget, you can use the worksheet feature by clicking on the worksheet button next to the line item you want to enter that budget for. Instead of entering the $20,000 all in one line, we could break it up into various categories. It's all going to fall into the same account number and category number, but then we can put in a little bit more specific detail of what this is for. You'll need to put some type of description under the description line for the system to recognize the use of that line item. Otherwise, you will get an error message if you don't put a detail. So we're just going to use open text message and just type in whatever description you want here. You can also add additional comments in the comments category or column. If you want to give a specific project name or a specific vendor name, you can also add that additional detail. Whatever is going to be most beneficial to you to make most sense to you so you can remember what each of these categories are for. Once you're done, you click on Save, and you'll see it'll summarize it all into that same $20,000. We selected spread at 445, so you'll see that 445 spread. Again, as we finish a screen, we can click on Calculate, and we can see how that affects our profit. We can see our profit slowly decreasing as we continue, well, actually increasing at this point because we've only added more revenue. As we progress through the system, we will see the profit to decrease as we start adding expense line items. Once we're done with the screen, again, we'll hit Next to go to the next questionnaire. This is your accommodation sales, revenue, and expense budgeting screen. An accommodation sale is a client purchase transaction where a purchase is made on behalf of our client that is outside of our normal service agreement. There are two budgeting options, as you can see. One where Aramark does not provide labor or services or installation with the equipment purchase, and the other option is where Aramark does provide the labor and or service or installation with the equipment purchase. It's important to determine when you're budgeting for the accommodation sale whether or not we are providing that additional service of labor, service, and installation, because it will affect whether the full amount of the expense is recognizable as revenue or if only the profit portion is recognizable as revenue. For example, if I put in $10,000 where Aramark does not provide labor service, you'll see down below that our expense will be wiped out. We will not be able to recognize that revenue. We will only be able to recognize the markup amount, the 10% markup of $1,000. We'll be able to realize income of the $1,000. We will not be able to realize any of the income for the full $10,000 of the pass-through costs because we're not providing the labor. But if we zero this out and Aramark is providing the labor or installation for the exact same $10,000 purchase at the same 10% markup, then you will see we are able to recognize the full $11,000 revenue minus the $10,000 expense for the profit of $1,000. We'll move on to the next screen, which is Base Business Build. This is the screen that will be used for budgeting for any targeted growth for the fiscal year. Those target values, again, will be released soon by your regional finance director and communicated to you either directly by your regional finance director or by your district manager. Once you receive those growth targets, the first line is sales. That's where we're going to build the growth revenue. And then the following 4 lines are all expenses that will come out of that revenue, leaving your profit. So if you're given a target to grow your profit by your revenue by an additional $20,000, you can either again spread it 445 an even spread, or you can choose to start the growth later in the year, let's say around January, and then click on repeat that value evenly for the rest of the year, and it'll build that revenue from January on, depending on the direction given to you by your district manager on how they want you to build that additional revenue. So let's go back to the example of $20,000, and we'll just do an even spread. And then out of that $20,000, let's say we have $10,000 in salaries and $2,000 in direct expenses and maybe $3,000 in supplies expense. So it's going to leave us a profit of $5,000. So again, whatever direction you're given for your base build growth, you're going to be given a revenue target and a profit target, and it's up to you to build that to come to those directed amounts. All right, the next screen that we're going into now is we're getting into our expenses. At this point, we've only worked on our revenue. At this point, we've built a revenue of $344,000 with zero expense, so it's showing 100% profit of $344,000 profit at this point. Now we're going to start building all of our expense line items. The very first one being labor. This first screen is some basic setup for how your benefits and expenses will build based on your salary types, whether hourly employees or salaried employees, and whether you have a union benefit plan or not. By default, over on the left, you can see here the error mark paid non-union hourly employees are set up as a benefit cost of 10%. Down below in the middle, error mark paid salaried exempt employees. By default right now, it shows a contracted rate of 0%. You can type in that percentage based on your contract type. Right now I see on this profit center number, these two options of SPC and SBC are grayed out. I would assume that based on your contract type and your profit center number, if your account is an SPC or an SBC account, that those will be selected by default. Over on the right here is your union pension health welfare expense, which can be budgeted either by the weekly amount, a fixed dollar amount by employee, or as a percentage of salaries of each individual employee. If you do enter amounts here under union pension and health welfare based on your contract and whether you have a union, when we get to the hourly employee questionnaire, you will have to check the box under the union plan column to enable it to trigger the calculation of the benefits based on this screen. I'm going to click on next. The wage expense amendment. Many people last year I noticed confused this screen as the screen where they budgeted the annual merit increases for their employees. This screen is not where you're going to budget for your annual merit increases. This screen is specific to your contract amendments. If you have a contract term that specifically designates a percent change within a given month as a across the board increase for all your wages, then you would enter that in this screen, whether it's taking place in the fourth quarter of the current fiscal year in July, August, and September. And if you have a specific increase that's being mandated by a contract term of 4% across the board, then you would build it in this screen right here. Or if it's going to take place sometime next year, as you can see by default, it pulled in January 2.5%, which is the same that we had already budgeted on our contract increase page. Many contracts that do have a wage amendment, though they will coincide with the contractual fee. That's why by default that pulls it in. But if your contract does not call for that, then you're going to want to zero this out by selecting no month to remove that. Again, this page is only used if your contract or amendment calls for an across-the-board wage increase at some point throughout the year. Once you select the top, then you're going to say whether that's applicable to just your hourly employees or your salaried employees or both. For this example, we're not going to put anything on this page. Most of the contracts I'm familiar with do not have a wage amendment increase. So we're going to progress to the specific labor questionnaires now. The first one is your hourly non-exempt employees. I'm just going to minimize the size of the name here to hide the employees' names for confidential reasons. The first thing I want to point out to you is on the bottom left of the screen is a payroll import button. When you click on this payroll import button, it will pull in all your salaries and wages of your employees that are currently on your payroll. It'll pull in the employee's name, an alias number to identify them, their job code, their full-time FTE status, whether 40 hours a week full-time employee, or for example, this last person's a 20-hour-a-week part-time employee, their current hourly rate of pay. This is where you're going to budget for annual merit increases for individual employees. Again, you will be given guidelines from either your regional finance director or your district manager as to what percentage to budget for next fiscal year. For this example, I will go with a 3% merit increase. If I select it and put it in this top yellow section, it'll apply it to all of the employees equally. And by default, you'll see that it's budgeted to take place in period 4, which is January, which is our arrow mark normal annual merit increase time period. If you have a unique situation, maybe contractually or locally, where your merit increases go into effect in a different month for your hourly employees, then you can override that and type in the fiscal period. A few other features on your hourly employees. You have your monthly hours that automatically populates based on our 4-4-5 week period. 40 hours a week for a full-time employee for a 4-week period being 160 hours, and 40 hours a week for a full-time employee for a 5-week period being 200 hours. It automatically populates for the full year. If for whatever reason you have in your budget that you need to budget an increase in FTEs mid-year, you can add individual employees, add in their names and their job code, whatever that job code might be. You can just copy and paste this similar to an Excel file. Put in their hourly rate, whether they're eligible for an increase or not. We'll say that these are not. So I'm going to put in the 0%. And then we're going to go over here. Whoops, did not mean to check that. We're going to go over to their monthly hours. And if this employee isn't going to start until January, then we're going to zero out their hours for the first quarter, because I'm not planning on hiring these positions based on our contract terms until January. The next section over is overtime. You can budget overtime for each of these individual employees based on your anticipated need of overtime by employee. You can see that the overtime rate is already automatically calculated based on time and a half. And then these are monthly amounts, so you can estimate how many hours you plan to pay overtime in any given month. Perhaps you have a few employees you can pay overtime because they're working on the holiday, so they get overtime pay. And you can put in whatever those hours are that you think that you're going to incur by month for those employees. Some of you, and depending on your line of business, may have shift differential pay, where an employee may earn an incremental amount for working on an odd shift, a second shift, or a third graveyard shift. There you will have to put in that shift differential. Let's say this person earns 50 cents extra per hour for working night shift, and let's say half of their shift overlaps on night shift. So half of their 160 hours, 80 hours is on night shift. And if that's going to take place for the whole year, I can click on this repeat hours. It's going to ask me if I want to repeat the hours evenly or 4-4-5. I'm going to select 4-4-5. So it can have the same pattern of half of their shift, whether it's a 4-week period or a 5-week period. It's going to budget for that shift differential rate of pay. Another feature on here, you can see there's a repeat row. If I want to repeat this last row to add a few more employees that I'm planning on starting and hiring in January, I can highlight that row and then click on repeat row as many times as I need. and you'll see it repeated, the same designation of the job code, same rate of pay, and the same hours starting not until January. So just some quick, easy features to make the budgeting of your labor easier. You can budget, as you see in this example, by importing it individually for every single employee one at a time, or if you have a large group of hourly employees and you prefer to group employees by job code category, you could say you're going to hire 20, number of employees. It's not letting me type 20. There we go, 10 employees. Not sure why I'm not able to hire more than 10 employees. But you could put in the number of employees, 10 housekeepers at 40 hours a week times $10 an hour, and then it'll calculate this line based on you hiring 10 employees at this job code and this rate of pay, as opposed to one individual employee. It's just another option of how you can budget for your hourly employees. Once you're done with the hourly employee budgeting, click Next. Next category will be your salary non-exempt employees, which are employees that are paid by the hour but earned salaried benefits. Again, I'm going to minimize the name section, and this works the same way. I can just click on Payroll Import, and it'll import whatever employees I have at this location. And you can update, again, if you need to make any changes, you can just type over any of the fields. If you've made any changes, you can either start with the import or you can just manually enter all these hours. And all the other features are the same as the hourly employee. You can budget overtime, shift differential, or just straight pay. And you can repeat rows if needed by selecting the employee and then clicking repeat row. Once you're done with the salary non-exempt employees, you can click Next. And move on to your salaried exempt employees. Same thing, if you have any salaried employees, you click on the payroll import, it'll automatically import, or you can just manually type in the name of the employee. You must select their band level for the salaried employees, whether they're a band 8, 7, 6, 5, whatever their band level is, and then select the proper job code description, their annual rate of pay, again the percent merit increase. This one does not give you a month to select. By default, salary managers will always be receiving their merit increase in January. And then you also have a place to budget for the manager incentive bonus. This percent allocation column is in case you are overseeing various profit center numbers and you want to allocate a percent of this manager's salary over a couple profit center numbers. You can type in that percentage in here, and then you can duplicate all this information in the other profit center number and put in the balance of that percentage. And when we're done here, again, we click on Next and move on to the next screen. Other payroll expenses can be used to budget for any other payroll that may not have been captured in the previous screens. So again, some examples here could be labor for special project work. Here's where I meant to say we can budget for agency labor expenses or any other payroll adjustments that we may need to budget for example, of transfer journal vouchers, TJVs, of moving labor between profit centers. Perhaps you use and borrow labor from a nearby facility during the summer to supplement your labor. So then you can go in here and budget, labor expenses just for those summer hours based on the amounts that you anticipate incurring. Again, you can either budget based on a spread type of 445 or even, or you can use a worksheet to provide more detail. Again, for example, if I want to use the payroll adjustments line, I can click on use worksheet and I can budget for summer labor support from whatever location, or I can give it a special project name. whatever additional information that you find useful for yourself, and then whatever you normally spend on that summer labor, um, whatever amount you need to budget that you expect to be TJV'd for that labor. Or maybe you have ongoing labor support that's ongoing, perhaps a fixed amount even each month for controller support. So any other labor transfers, maybe this is where you want to budget a frontline manager shared with your plant operations management location. Maybe they send half of the labor over to environmental services, and so you can put in that labor, and maybe this is a 4-4-5 spread. So again, whatever detail you want, by using the worksheet option, you can provide all that additional detail. Click on save. It'll sum it all together into one line. Anytime you see detail under here, it'll remind you that you have a worksheet where you've built all that detail. So again, as a reminder, as you're adding additional expenses, you'll see that down here under FLC, it'll say press calc. Every time you make a change, you can click on calculate, and it'll update your profit. And you can see again, this number continues to decrease as we increase our expenses. Once we're done with other payroll expenses, we can continue on to the next screen. The next screen is supplies. Again, you can see all the various supply account category types. If you have more than what fits on the screen, you'll see the scroll bar over here on the right, where you can click on down to see all the available expenses. As mentioned before, there is always a previous or current fiscal year 2017 actual projection for the year based on what your actual results have been year to date and what you've projected for the balance of the year. So you can see as a comparison, as a guideline as to what you might need to budget. So for example, we're currently for paper disposals around $18,000. There's your starting point of $18,500. But one of the examples we talked about in the initial training was there might be one-time events. Perhaps there's a one-time event that has not yet happened where you're going to incur additional paper disposal expense. Hopefully you've accounted for that in your projection and you have an accurate projection. But if while budgeting you realize you forgot to project for an expense coming up this summer in June and July, some special events where you're going to have an increase in your paper supplies and you forgot to project it in 2017, well, we can start with this full year 4-4-5 trend, and now we can go and override maybe in June that we're expecting a $5,000 increase in supplies, in July $5,000 in supplies, and now by default it's going to change the spread type to none because it now has a unique spread because of these two overrides that we plugged into June and July. So again, you can just continue going through, seeing where you need to budget based on your current year. And again, a starting point, you could just start with your current trends and then evaluate the detail of what you're actually expecting for next fiscal year based on any scope changes, special projects, any other contractual changes that may affect some of these line items. And you can adjust those from there. So again, I'm just plugging in some numbers. We're going to hit calculate. And you can see again, oops. Well, I expected to see FLC drop as we increase expenses. And you see, as I checked it, our FLC actually did not drop at all. It's still at $326,000 profit. So again, that's a good check, like I said, to continue checking your revenue and your profit as you build your budget to make sure it's acting the way you expected. And this one is not acting the way I expected. So the first thing I want to go back to see is what type of contract type do I have? And if I go back to the general setup, center setup, I'll see that I do have a contract type of a P&L. So if I go to the questionnaire, revenue reimbursable, here's where I made the mistake. This is a P&L account, so none of these should be a pass-through reimbursable cost. These should all be coming out of my fee. But when I was doing the example, I typed in 100% default markup. So you can see that by default, it's assuming that I want to pass through every one of these line items that do not have exclude as revenue, as billable to my client. So I need to change this to 0% because, as I mentioned at the beginning, P&L accounts do not use the screen. So we need to leave this as 0 so it properly calculates this contract type as a P&L, and my revenue is not affected by our costs because all these costs of salaries and supplies and other expenses should be getting deducted from my contractual revenue. So now that I've corrected my mistake and changed this default markup to 0, thereby making this screen pretty much inactive and not affecting my budget at all, when I click on calculate, you will see that now, there we go, my profit has gone to a loss now of $100,000 because I've already built in more expenses than my contractual revenue. So I'm going to continue where we left off. I'm going to go back to questionnaire and go back to supplies where we left off. And again, the reason we're budgeting a loss at this point because I just arbitrarily made up values as I'm building this budget. And so as you can see, where we are currently on the questionnaire, that are compared to last year, we have a revenue of $357,000. I've built a revenue of $369,000. But if we look at our costs, and you can see that I've already built much more labor than last year, and I've already built more supplies than last year because I just arbitrarily put in a lot of examples to build this budget for this training purpose. So we're going to continue on. It's now acting the way we expected. As we increase expenses, it is directly coming out of our profit. So we can go ahead and click on next to go to the next questionnaire. So this next questionnaire is for budgeting assets and depreciation for capital purchases. You'll see that there's 3 tabs up here on the top. This first tab will list any current assets you have on the books on your fixed asset detail list. This example has none. The second tab is where you would budget for any capital purchases that you're planning in the current fiscal year of 2017. So between the months of July, August, and September. And then the last tab is to budget any capital purchases you're planning on making with next fiscal year beginning in October of 2017. The way this works, you first decide whether you're purchasing an EVS piece of equipment or not. If it's an EVS piece of equipment, you click on yes. Then you have to pick from the default list of standard EVS equipment. You find the equipment you want to purchase. It'll be by default select the correct account category. It'll put in the current selling price. By default, it'll have 1 piece. If you want to change that to multiple pieces, you can do that. Then you need to type in the date of purchase. So for example, let's say we're going to purchase this in July 3rd, 2017. And by default, most of this will be depreciating over 60 months. It's important, again, to know your contract terms, when your contract expiration date is. Because although by default the system will budget based on 60 months, your contract may be expiring in 3 years. You cannot budget to depreciate items longer than the life of your contract. So if we can only budget this over the life of the contract and the contract only has 3 years left after July of the current year, then we're going to need to change this to a 36-month depreciation life to make sure that the depreciation is the asset is fully depreciated by the end of the contract. If you need to purchase something that's not in the list of EVS equipment, then you're going to select equipment type EVS no. Then you have an open text and you can type in whatever the description of the item is. And then you will have a choice of a few account categories of where you want to post that depreciation to. This is office equipment and furniture. Then again, you put in the purchase price, the quantity, the date of purchase, and again, estimated life of the equipment. Again, it can't be greater than the life of your contract. So again, I'm just going to go ahead and just delete this line. And both tabs work the same way, whether you're purchasing it in the current fiscal year or next budget fiscal year. As you build in all your assets, it'll calculate the depreciation down here below. All right. So going on to the next tab. After assets, we have intangibles. Intangibles is very similar. The difference between assets and intangibles is the assets are Aramark owned equipment, whereas intangibles are buyback investments or purchases such as construction or renovation projects and not necessarily a physical, tangible piece of equipment. It's built the same way. You put in the description of what it is, building renovation, pick account category of whether it's an amortization buyback or a non-acquired intangible, whatever you want to book it to, the total price, the quantity, date of purchase, estimated life of months that you want that asset to be amortized over, and the salvage value at the end of that period, which normally we would budget at $0. And then you would just hit continue. Next. All right, just a few more screens and we're almost done. So this screen is recruiting expense. It's based on your turnover and it's based on hourly paid employees. So for this example, we had 12 hourly paid employees budgeted. Let's say our turnover rate is 30%. And then you can build in what your cost is for the pre-employment screening for an individual hourly employee, background checks, drug screening, hepatitis vaccine. So I just left these default amounts in. You can modify these to reflect what your actual cost that you incur. And then based on that turnover and your number of employees, it'll calculate a budget value for you. There is a blank line item here that you can override if you need to adjust those values up or down if you like. Click on next and we go on to computer usage. By default, this will pre-populate based on the current assets, not assets, but computer IT equipment that you own at your location. And then you can always modify it from there. For example, if I decide I'm going to purchase 2 more desktops and I want to repeat that because it's going to be the same desktop charge for the whole year, I can add that in. Same thing with laptops. If I'm going to add a laptop and I want to repeat that value evenly for the full year. So you can modify that. These are just quantities of these charges. If you want to see the results in dollar value, you click on results. And the results screen, you will scroll down and look for allocation charge outs for computer equipment. Here it is, and you can see the charge I built for those 2 desktops and 1 laptop is $320 per month, and so it will build that budget accordingly. We go on to the next screen after computer usage, and that's other expenses. Other expenses are all other direct line items that we have not yet addressed. So again, you scroll down the screen, it goes for quite a few pages, and it'll capture every other direct expense line item you can imagine. Again, as we discussed on the previous screens, you can use a worksheet for additional detail. Select your spread type of even, 445, or none, and you can look at your fiscal year 2017 current projection as a baseline guideline on where you might have items that you need to budget for and what amount to budget for, and you can build those budgets accordingly. Once you're done, you click on next to go to the next screen, and these last 2 questionnaires, let's close the results tab. Give it a second to catch up, and give me a minute. I just crashed the system because I had the results tab open. I apologize for that. Give me 1 second to bring the system back up. Okay, so here we are back to where we were, the other expense screen. And we switch back to the profit center number that we were working on. And go back to other expense, other expenses. There we go. All right, so we click on next. And this next screen is the balance sheet items. You can ignore this. It doesn't affect your actual operating expense budget. And unless you're otherwise directed by your regional finance director or district manager, you can go ahead and ignore the balance sheet items. And the last screen, days outstanding, you can also leave the default of 30 days per month as well. And this is the last screen of your budgeting process. So again, once you're done, you can click on results and pull up the detail. And again, this result screen functions just like the result screen on your projection module. So hopefully by now you're familiar with it. You can compare what your full 2018 budget plan is compared to your 2017 projection. You can look at the detail by month. If you have a significant variance, as I do with the profit, which we already recognize has to do with my arbitrarily increasing the salaries significantly for the training purposes, we can always select some of these comparisons down here. Views, monthly prior year. It'll populate with each month's fiscal year 17, so you can compare on a monthly basis by month where you have a variance if you want to analyze that. Or you can reduce this full account and category detail to just account numbers. It'll get rid of the category detail to make it a little bit simpler. You can continue to simplify it by summarizing it by group. Or you can go all the way down to consolidated, where it just has top line expense of revenue, cost of sales, labor, directs, and total expenses. Excuse me. So that brings us to the conclusion of our training. Once you've evaluated everything, you've identified any variances, you can go back to any questionnaire you need to modify. For example, with the payroll one in my example, we realized that I over budgeted our hourly employees. I can go back and delete those line items that I budgeted by mistake and delete each row. And when I click on the results by calculating, I can see now that my loss is much better. It's only a $17,000 loss. And so again, we can go through and visit any page where we need to make any adjustments. Go to any questionnaire directly where we need to modify anything, and continue to monitor to make sure that our results are what we expected, that we're getting closer to our target. Now my 2018 planned revenue is only $11,000 greater than 2017, and my profit, although it's a profit, is $35,000 less profit than last year. So again, you can use all these reports and data just like you do with your projection module to then review with your district manager or regional finance director to finalize your budget. Again, coming shortly, be looking for emails for any further direction on targets for your targeted growth, or your targets for your annual CPI increases, or targets for annual merit increases. Thank you for your time, and good luck with your fiscal year 2018 budget. Goodbye.